Reserve Bank recently wrote to all banks and NBFCs to be careful about retail, especially unsecured loans. Now, is the regulator worried about banks and NBFCs? Why is he worried? Is there a sharp rise in some kind of unsecured loans like personal loans, credit cards? Are there more defaults in this personal loans category? We have a report from CIBIL which shows that for the quarter ended December 2022, home loans, which is a secured product, actually dipped. But personal loans and credit cards, which are largely unsecured, rose the sharpest. Now, CIBIL's press release also points out that NBFCs showed the sharpest rise in personal loans compared to pre-COVID levels in particular. Not much of a rise if you look at PSU and public sector banks. And now let me come to the troubling table from the CIBIL release. Collection efficiency for personal loans and credit cards appears to have fallen from the previous, the December quarter from the year-ago quarter. Also, if you look at delinquency, now by delinquency, CIBIL means borrowers who delay their interest payment by more than 30 days within the first 6 months of getting a loan. That category has risen very clearly for personal loans if you compare it to pre-COVID levels. Now, this is data only at the start of the rate hiking cycle. With rate hikes getting passed on, should we expect more delinquencies? I have with me probably the best of panels, Rajesh Kumar, MD and CEO of CIBIL, who is, of course, the person who has put together this data. Shanti Ekambaram, she is the whole-time director and person in charge of consumer banking at Kotak Mahindra Bank, and Kartik Shrinivasan, Senior Vice President and Co-Group Head, Financial Sector Ratings at ICRA. Shanti and gentlemen, thank you very much indeed for joining me. Rajesh, I'll have to start with you since this is your report we are largely discussing. RBI writing to banks, do you think there is enough fodder in your report to worry them?
Good morning, Lata. Good morning to all of you. I think, first of all, we've had a good run for 2 years of very robust growth. As we say, probably the only shining economy in the world. So we've had growth across products, we've had growth across age groups and demographics, we've had growth across almost all states in the country. Now, when RBI talks about a little bit of a caution in unsecured loans, I think it's very timely advice and very prudent, because this growth story has to continue, and the only way it can continue is to ensure that there's responsible lending all around. And there are, whenever there is a lot of growth in retail lending, there are bound to be small pockets where you will find a little bit of an issue with volume and velocity, and that's happening in a small portion of unsecured loans below 50,000 in particular.
Okay.
So I think it's very timely advice from RBI to be a little more cautious in these few segments.
I'll tell you why I'm asking you this question, because, you know, some parts of your press release are actually showing a good picture. I'm particularly looking at upgrades and downgrades. You're saying that the number of upgrades has risen. The number of people in the same level, same loans, are actually higher at 41. And number of downgrades have fallen from 28% to 20%. So it's also giving a mixed picture. Personal loans, delinquency higher, collection efficiency down, but the number of downgrades are also falling.
So that's a great question, Lata. So actually what's happened is, in the last 2 years, we've seen a huge change in the retail lending portfolios. So if you look at it sheer volume-wise, number of loans, the number of loans below 50,000 and on very short tenors like 3 months, 1 month, 6 months, they're very high. So within personal loans, 82% of loans on volume are below 50,000, though it's only 8% on value. Now, all of what I'm talking about at a total retail plus MSME book is less than 1% of the total book at a country level. So it's a very small book, but very high on volume and velocity. That's why what you're seeing in that report is that all the others, you see good indicators everywhere else, and you see the small increase in a small segment of personal loans below 50,000.
Okay, so that's the category to worry about. Shanti, now to come to you. This is not really a banking sector priority area, isn't it? I mean, I would think that 50,000 and below would more be NBFC fintech kind of loans. What has been your experience with small loans?
So firstly, Lata, I want to just add to what Rajesh has just said. You know, there has been phenomenal growth, and there are 2-3 reasons for that. One, post-COVID consumption. Second, credit being available at the point of consumption, what you now call buy now, pay later, or whatever it is. Credit being available at the point of consumption. And third, rich data and data science models being available to make credit available online real time. I think this has changed the trajectory of consumption finance, as I call it, which is largely unsecured loans. Okay. Now, if you saw the numbers of all the banks and even the large NBFCs, you're seeing no signs of any stress or delinquencies, and everybody is saying it is looking too good to be true, and there is a stability. So I think it is very largely an NBFC play. But I don't think banks are completely out of it. Like I said, it is at point of consumption. The advantage that banks have is the amount of transaction data. You know, CIBIL provides wonderful data, but the amount of transaction and other data that banks have to be able to offer credit at the point of consumption is really large. And lastly, let me tell you, with credit on UPI becoming available, which is really the payment point at point of consumption, this is going to go up even further. But 2 things are important. One, lending is the easier part. Collection is the more difficult part, particularly in loans of below 50,000 rupees. People need to have their collection mechanisms in place, monitoring and collection, which is not easy. Probably why the central bank has cautioned to say it is not just enough to lend, and that may be one of the reasons why you are seeing, you know, the DPD that you talked about, 30-day increasing, is collection mechanisms must be in place and keep speed with the disbursement that is happening. Second, this is largely personal loan, but there is a commercial end of the loan, business loan also, which is increasing, which so far has not been disbursed. Oh, okay. So this is broadly how I think.
Okay, no, but Shanti, you know, how does a bank inform us, and I guess even inform themselves, about weakening loan parameters? You tell us NPA after it's an incurred loss. And then you'll tell us about SMA 1 and 2, but I think that's more for large loans, you know, 5 crore plus. Is there any way you keep track or you tell us in your results about these smaller ticket 50,000 rupee kind of loans? Are you aware whether they are in good health?
Lata, banks monitor from 0 DPD, plus 1 DPD, not just 0, plus 1 DPD, then 30 DPD, and then thereafter. When it reaches plus 1 DPD, all banks monitor the plus 1 to 30 very closely. Because in the unsecured business, if it crosses 30, right, your recovery percentages go down when it goes beyond 60. Banks actually have very strong monitoring mechanism at plus 1 DPD.
And are you feeling reasonably and are you feeling reasonably sure about your own portfolio in
absolutely those? Absolutely. See, I come back to this, Lata, is that the data science available, the big difference from pre-COVID to now is the quality of data that is available, the quality of transaction and other patterns that you have, that you can qualify customers. Okay. Most banks insist on 700 plus. That's now become a norm across the industry, 700, 750 plus. But I think the enrichment happens from the data science, but that alone is not enough. Monitoring and collection is equally important. And right now, system seems to be managing it reasonably well.
Okay. Well, Rajesh's press release is also saying that more loans have been given to the near prime category. Prime and subprime have remained static or even a little less. But in terms of loan origination, near prime, that is a little more risk is what banks and NBFCs seem to be taking. Now, Kartik, if you put all this together and your own data at ICRA, what is the sense you're getting? If this is still early stage rate cycle getting passed on, a little more is going to get passed on as the reset period comes for various loans. So do you see red flags at all, especially in unsecured loans?
I'll say in terms of interest rates, the borrowers have seen higher rates in the past. For the last couple of years, the rates have come down. Now they're again on their way up. So the new rates are not something that the borrowers have not seen in the past. So we believe that they should be in a position to navigate through a rising loan interest rate scenario as well. At a broader level, whenever a segment grows very fast, we are obviously a bit concerned about that. We remain cautious. Even now, it's not a handful of entities, but basically most of the players, large or small, have grown pretty sharply over the last 12 to 18 months. If we were to just look at it at a slightly longer horizon, last CAGR of last 3 to 5 years, maybe the numbers won't look as high as what one looks at for the last 12 to 18 months. But clearly, as Rajesh and Shanti articulated, the quantum of data that is available today and our interactions with banks and NBFCs, there is clearly a preference for better rated or borrowers with higher credit scores. To that extent, the cherry picking of portfolio is definitely happening.
Okay.
We also understand and believe that the approval rates are coming down because there is so much of consumer demand which is coming at the ground level, which enables the lenders to sort of cherry pick the borrowers whom they want to onboard within their broadly defined risk parameters. And more importantly, if we were to look from a rating point of view, an additional comfort that we derive as of now is the fact that the balance sheet of banks and NBFCs have actually strengthened over the last couple of years.
Okay.
The incremental regulatory measures have also ensured that the liquidity profile is stable and entities should be in a position to manage little bit of volatilities here or there.
Fair point. Okay, got that, Kartik. We have to take a quick break, but we have lots more questions on how competent is this data footprint, the digital footprint that Shanti has been talking about, and whether we should start seeing more, delinquency as interest rates start getting passed on. All those questions after the break. Welcome back to Indianomics. I've been discussing with Shanti Ekambaram of Kotak Bank, Rajesh Kumar, the CEO of CIBIL, and Kartik Shrinivasan of ICRA, whether we should start worrying about unsecured loans or any deterioration in retail loan category. The question is rising because Reserve Bank has written to banks and NBFCs. Okay, Shanti, you proved with chapter and verse that a much larger amount of data footprint, digital footprint is available, which is why loans, even retail, even very small loans, are built on good data. But, people change when circumstances change. I mean, you probably have data of a person paying his phone bills on time and electricity bills on time. I don't know what kind of data footprint you have. But if there is a problem in terms of job losses, startups shutting down, etc., then all these will weaken together. So how secure are you about this much lauded data footprint?
So two things, Lata, right? This is very closely linked to the macro environment. If you see, the macro environment has been extremely stable for the last 12 to 15 months, and this year also looks stable. Yeah, while you have seen some of the new age companies, melt, I don't think they were sort of really borrowing a lot, at least the individuals there. But I think you have to watch the macro factors very closely. Remember, these are unsecured loans. When macro goes bad, right, unsecured loans start seeing a little bit of a worry. What is also different, which I have not stated earlier, is you have to look at the risk-adjusted return of any segment. Probably one of the reasons why the growth has been sharp is the risk-adjusted return in this segment in the last 18 months has been extremely good, which means the risk has been well managed and the returns are very good, and which is why people have been this thing. So I would watch and monitor macro and external forces very closely. This is apart from monitoring your portfolio. One would also keep monitoring transaction data to see, are you seeing external delinquencies? Are you seeing trends which change? Any unsecured business depends on the macro, depends on the micro, and needs close monitoring. So I am always watching closely all the time.
Okay. No, I just worry that the way people, Germany went into recession just yesterday, and people are very seriously talking about a possibility in the US. If destination countries for our exports are facing trouble, it's quite possible that SMEs who cater to these could be having a problem. But I'll come to that macro in just a minute. Rajesh, you know, I just want to know, you are making these PowerPoint presentations every quarter. Now, would you worry with the small changes that you have seen from the long experience you have?
Lata, I think these are very early trends. So if you look at the kind of, again, like we discussed earlier, there's just so much data and analytics and all sorts of algorithms at work. So I'd like to point out 3-4 things when we talk about whether we should be worried about retail loans or specifically unsecured, etc. I think it's important not to throw the baby out with the bathwater. We are on a nice growth path. So to zero in on the real issue, right now, we've done a study to study leverage and see where exactly this is happening. There are 3-4 simple things that emerge within these loans within less than 50,000. So for example, in the population that already has taken 3 loans in the prior 6 months before taking this loan, that percentage has gone up from 22% to 59% within the 50,000 loans. And then in this segment, the delinquency has increased expectedly. Okay. Likewise, where there are many inquiries in the latest 3 months. And then thirdly, where there is a buildup in the balance in the last 2 years, coupled with these parameters. And lastly, where there is already a BNPL loan existing. So these are very small, very small number of customers within the overall India scheme of things in terms of value. Yes. But I think what we are doing now is trying to catch these trends very early, okay, so that, like Shantiji said, as long as we can monitor and ensure that there is no concentration risk, study leverage ratios carefully, watch young vintages very carefully so that we learn where these issues emerge and shut the tap quickly or manage those portfolios better. Okay. Then this growth trajectory can keep continuing for us.
Well, Shanti has to leave in a hurry. So, you know, very quick question to you before I go to the gentleman. Shanti, I spoke to a bunch of past and present regulators in preparation for this discussion. And I'll tell you where their worry is. See, gold loans were given only by a couple of NBFCs. Now a whole bunch of banks, public sector and private sector, have started doing that, and the rates have fallen very sharply. Likewise, personal loans. Some banks and some NBFCs were lending a little. Now with NBFCs plus fintech, that has gone through the roof. That's what's worrying them. Too much is being done, and whenever there is exuberance, they worry. Would you say that this could lead to bad loans at some places, not in all institutions?
So, Lata, 2 things. I repeat, whenever there is very sharp growth, regulators have to look at it. And there has been a sharp growth if you look across NBFCs, banks, including banks lending to NBFCs. I think what is important is really the underwriting philosophy at each of the various locations. It is possible. See, there is no standardized underwriting philosophy across any even 2 institutions. Data availability, models, algorithms, as Rajesh rightly said, are used by all the players in different ways. So what we have to watch is, is there sufficient sophistication? Is the pricing appropriate? I think you raised a very relevant point. This is risk-adjusted return. If you start pricing this wrongly, it can go the other way. So I would watch to see, how it goes, because it really depends on how people are underwriting, how people are monitoring, and how people are pricing. Okay. Having said that, if the economy remains in growth phase and stable, if consumption, which is the theme which is driving the economy, remains stable, and credit being available at the point of consumption, this is likely to grow. But I would watch carefully and monitor it and make sure collection efficiencies are indeed correct along with pricing.
Okay, fair point. Shanti, thank you very much. My day job is as a macro data journalist, and you still make me sound relevant. Thank you very much for that. Thank you for joining us as well. Kartik, I want to put the same question to you. You know, gold is a collateral even for agri loans. Gold loans per se are rising. Gold is a collateral even for SME loans. Now, do you think over there we could be seeing incipient risk signs?
There is a possibility. What's happening is gold loans over the last 12 to 18 months, we've seen banks become very aggressive on gold loans. Again, it's largely linked towards the agri-related gold loan portfolio. Lending rates are much lower. So to that extent, one has to be a bit mindful of how that portfolio really plays out. At this point in time, the overall numbers are still comfortable. We're not seeing too much of a concern. But if that exuberance continues for a longer period, you know, that there could be periods where we see a volatility in the asset quality for this segment as well.
Okay, so maybe that's why the regulator and CIBIL are merely raising the red flags. Winding comments from you, Rajesh, since we are primarily discussing your press release. What would you say? It is just an initial warning, but we are still going to see a fairly strong performance from banks and NBFCs?
Oh, I'm very sure, Lata. I think one point we've spoken about the lender's perspective. We also have to keep in mind what the customers want. We have a large young demographic. We speak about them all the time. Now, I think one important point to note is that this population is not exactly looking to take a home loan very early or buy homes like perhaps my generation did. So while we talk about a consumption-led growth economy, this precisely is that consumption. So to that extent, I think it's a whole shift in mindset. There's no point getting negative about it, but it's important to understand these trends well and lend prudently and responsibly so that we also take care of, we also cater to the customer's needs in the end, which is this large young population.
Okay. Well, absolutely well said. The demographic shift is also introducing some changes in the category of loans that are running faster than others. Kartik, Rajesh and Shanti, thank you very much indeed for joining me. I think the key takeaway for me from this is that there are probably small, incipient signs in some small category loans, and the regulator is merely cautioning. We still probably have a good run of both the economy and the banking and financial sector, but it is good to be aware that there are these incipient small signs of trouble in small ticket loans. We wrap up on this very special edition of Indianomics. Thanks for watching.